Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really looking forward to being able to help you with your retirement. We focus on retirement planning, asset management, and tax planning and retirement, and it's a question and answer show. So please just send in questions. We'd love to answer them live if you'd like. You can do that two ways. You can send them by email if you prefer. So ask Tom at talkmoneywithtom.com, or there's a chat feature if you're signed in for the YouTube channel here. You can do that also. We get questions throughout the week from our clients. We've got quite a few this week, actually. We'll cover some of those also. So looking forward to that. We've created this channel. The idea being that, there needs to be more education in these three areas. It's not something that's really taught out there very much. And that even if you have an advisor, the more that you learn about how these things work, more you learn about how the markets work, for example, the better you will be in interacting with your advisor and most likely be a better investor is our hope also. So you can go to our channel, you can subscribe to the channel, hit the subscribe button, you see it right there. And then also there's a little bell if you want to be notified whenever we put something new out. And then, of course, if you like, you can just meet with Ethan and I. We'd be happy to talk to you, 30-minute appointment on video, phone, in office. And you can do that by going to this book appointment button, which is on our actual website for our business. The link for that is here on the channel also. That button is up in the corner. It looks just like that. So look forward to getting a chance to talk to you if you'd like also. So anyway, that's what's going on altogether. Really interesting time frame to be doing this, in my opinion, with all the things that are going on. I do like to start off each show with a summary of kind of what I saw happening in the markets this week. And there's been a lot going on this week, actually. So let me transfer to our little chart that we've been looking at all these years. So this goes back to 2018. Matter of fact, that first dip right there was caused by tariff increases, and it came back pretty quickly. And then, of course, if you look at what's happening right over Easton's head, that's more current data. Pretty fast drop. As a matter of fact, the first 10% drop in this downturn since these tariffs started was the fifth fastest 10% drop in the last 75 years. So the market's, obviously negative on these tariffs as a whole. And so this week, I think the things that are really important to kind of understand are, first of all, on Monday, the market dropped 2.5% and was actually down even more than that at one point in time. And that had to do with the fact that over the weekend, there was more tweets coming from Trump talking negatively about Chairman Powell, the head of the Federal Reserve. And so that was an issue that really, the market does not like at all. There's the whole concept behind the American kind of safety aspect has to do with, the supposed, stable political environment and this separation of, the central bank from politics. And so theoretically, in the past, you didn't even say anything about the Fed chairman. If you kind of look at what Biden did, I don't remember him saying anything negative or positive about the Fed chairman. Trump likes to try to put pressure on the Fed chairman. The markets get really antsy about that when that happens. And there was even one of the cabinet members who was saying on Friday, they were actively looking into how they could get rid of, prior to Powell's term expiring, how they could get rid of him. And so, boom, market drops. Well, of course, then on Tuesday, we hear from Trump, he had no intention of ever, letting Powell go or firing him. So markets responded positively to that. And then also on Tuesday, I think probably the most important thing that happened this week was a meeting that Trump had with the CEO of Walmart, Home Depot, and Target. And in that meeting, supposedly, they demonstrated what's happening. So with these big tariffs, especially the big tariffs on China, they were going to have a lot of empty shelves.
Yeah, just the amount of products that we use from China is massive.
Yeah, and so that image probably resonated with the president, and he started to talk in a lot more softer tones. Started to talk about how China tariffs they're too high. Secretary, the Treasury Secretary Besant also had a meeting, interesting meeting. It was actually a private meeting with a bunch of bankers where he said that the tariffs were unsustainable. And then that was private. Before that information became public, there was a bunch of trading that happened. And some of it, there were a couple trades that made a couple $1 million in about an hour. And that's being questioned right now, why that was being done behind closed doors, and not done in a public environment. But nonetheless, so you've got a concerted effort, the press secretary, everybody talking about how China tariffs are too high. You have the president saying they're actively engaged in conversations with China about these tariffs. China has refuted that and said that they're not having any conversations, and they won't have any conversations until there is a back off on the tariffs. They're basically saying, hey, you started this. You need to be the first one to step forward if you want to try to resolve this. Because the current tariffs at 145% is a blockade. And I think that's what the Walmart and Home Depot and whatnot and Target CEOs were saying is, look, we're not going to buy any of these products because it's too much risk. At 145% tariff, we're not going to bring it into our store and try to sell it, because we're either not going to sell it because we have to pass along too high of a cost, or we're going to end up eating a bunch of that in order to sell it, which is going to deteriorate our bottom line. So it's a huge problem, and so that seems to be an acknowledgement by the Trump administration that this piece of tariff that's coming from China needs to be resolved. But it's sort of a back and forth as to what they're going to do.
It's a game of chicken,
Yeah,
who's gonna duck out of the way first,
Right.
But I think China's in a stronger position when it comes to what they can withstand pain-wise versus the American people.
Yeah, I think when you line up like who has what on each side of this negotiation, China has a lot of things going for it. You have, the president of China is a lifelong appointment. He doesn't have the same pressures politically, theoretically, that Trump might have. They have been preparing for this tariff war since 2018.
Yeah, and I don't think American allies want to get in the middle of this.
No.
And so China's stuff is more precious than American dollars when it comes to the allies, I would say.
Yeah, and that's the other battle that's going on behind the scenes. Ideally, if this was all about China, which I don't think it really was. We'll talk about that in a minute. But if it was all about China and you're trying to box China in, you would have gone to all of our allies and started working on, better trade arrangements. And the concept being that, hey, we'll give you something if you will create blockades, so to speak, even minor ones, against China, so that, the world is putting China in a box. But instead, what we did was, and this is another piece where I think China has, an edge in this negotiation, we went out and put tariffs on every country on the planet, essentially, even though some of those are paused. And
we put ourselves in the box.
we put ourselves in the box. It's incredible, actually, because you're not going to get a lot of cooperation. And unfortunately, China now looks like the stable actor, which is not what they were perceived as before. So if you're Europe or Asia or South America or any of these countries, and China comes knocking and says, hey, we want to do a deal with you, but you have to follow these rules against the U.S. So, for example, they've got this rare earth metal, production that they don't want to be shipped to the U.S., right? And this is a huge deal. This is one of the advantages that China has also. They have a 90% of the world's rare earth processing is done in China. And so, for example, even like Ukraine, we were talking about trying to, get some payback for the money we've done. Part of that was going to be mineral rights. Part of those minerals are rare earth minerals, but those are in a raw form. They still have to be processed to turn into something you can actually use. China controls that processing. Part of the, that's strategic, but also nobody else wants to do it. It's very toxic. It's not a thing that people want in their communities as far as that goes. So, maybe it can be done someplace else. The U.S. can start to do rare earth processing and establish plants in other countries that are willing to take it. But right now, that's not the case. And so there's another piece where, China has an edge.
And China's going to the extent where they're asking other nations to stop their, shipping of, rare earth metal products to U.S. defense firms. So that would be transformers, aerospace, medical equipment from South Korea specifically to American defense firms.
Yeah, so think about that. I mean, they've got control. Another big one is antibiotics. They make 97% of the world's antibiotics. So that's a huge point of leverage that they can use in these negotiations. So China's sitting there with 125% tariff on U.S. goods. And that's another thing. Unfortunately, they can go other places for some of those U.S. goods. So instead of getting cattle or beef from the U.S., they start to get that from Australia. Soybeans, which is a big producer here in the U.S., that was being shipped to China, they can get from South America, Brazil.
It still hasn't recovered since the initial, in the first term trade war.
Right.
The tariffs. Soybeans never recovered their exports to China.
Yeah, and so, versus the other things, we have all these inputs coming in that we want to use for our, either something we want to buy or something we need for parts to put together, little things like screws and things that, would be hard to source in other places. And so, you have a country that, and since we made the first move, we have a country that feels like they're under attack. And so from a political standpoint, you say, hey, we're going to suffer through some pain, but we're going to fight back against this aggression from the U.S. Versus here, you got a very small group of people, very small, maybe 3 people, really, that are in charge of this situation of putting these tariffs into place. And there isn't, if you look at the polls, there is no U.S. belief. I mean, it's like 2/3 on the poll basis that don't like these tariffs. And so, you've got that. And so you got all these pieces going on that favor China and give China the edge. They're not going to come forward first. I don't see why you would. If I'm Xi Jinping, I probably want to impart some pain on the U.S. to try to make it less likely that this happens to them again at some point in the future, make this somewhat memorable. And so I'm going to be really tough on, bringing down my 125%. And so we're at 145, they're at 125. And so there was another rumor floated around where they might, as a sign of good faith, reduce the tariff on China by 65%. 2 things that I think about that. Number one, 80% is still a blockade. It's not that much different. It would make a difference to China, because they would look at that as a first step, and that is what they've been asking for, so that's great. But it also then puts China in a position of additional strength, because they're still at 125. So you're now at 80, and they're at 125, and they refuse to come down because they have all these other leverage points until you come down first. And so it's going to be this whole thing that goes around. If I was going to do it as a sign of good faith, I might go down to 125, at least be matching them. So when I get to the table with them, we're both at the same point. We'll see what happens, but expect Trump to blink, I'd say next week. This can't go on that much longer. I think we're going to start to see, some of these shortages. I keep reading article after article after article of companies that did stock up. I got an email today from a company saying, hey, we have 1 month's supply left. If you want to get something at the current prices before the tariff stuff starts to come in, you should order, right? And so there have been, retail sales were up 1.4% in March. I mean, it's just huge jump actually over what it was. And so people are running around kind of stocking up, but eventually that stock's going to dry up. And so that's why this timing of when this happens. So that's just the beginning. I thought it should have started this week. I thought the conversations should have started this week. They're claiming there's conversations, and China's saying there's not. We have to decide who we want to believe, in that regards. But irregardless, nothing has happened, at all. And so that's going to be very interesting. But I would expect next week that there's some type of, we've already had some walk back just in words, right? Mm-hmm. Hey, Trump says the tariffs for China are too high. I know that. We're going to find a beautiful tariff that works for both of us, and a great concept. And, and that could happen, but it needs to happen quickly because there's so many things that are kind of creaking on this. We've seen shipping from China drop 60%, right? And so it makes sense. I mean, why would you order anything if you think the tariffs are going to come down? You just wait. So you over-ordered, hopefully before the tariffs hit, and now you're just not going to order anything. Of course, that affects pretty heavy industries. We've already heard about layoffs in a Volvo, plant that makes trucks. So trucking and shipping is going to be less if there's less coming in. And you've also got, eventually if you start getting empty shelves, there's 19 million people working in retail, right? There'll be less people working in retail if there's less to sell, just as a defensive measure, from Target, Walmart, Home Depot, whoever it might be. And, these are the companies that can survive and deal with this. The real backbone, which is not being talked about at all, which is the small business, they're just going to go out of business.
Yeah, they can't survive.
No, they don't have that resource. They can't pay the tariff. And so this tariff is the thing. It's the thing I think about the most. It's still out there. We went from a 2.2% net average tariff prior to Inauguration Day to now a 27% net average tariff. That's, more than 10 times higher tariffs. A big chunk of that is because of this 145% on China. If we get that back down, to something more reasonable, say 25% or something, which is still really high, however, could be, sustainable. So that's what's going on, and just in terms of the dynamics between this. And to me, it all revolves around China. Whatever other positive information we get, like, we made a trade deal with India or something along those lines, will be welcomed because we need to start knocking those out too. But if you don't have China, you have problems. You don't have antibiotics potentially. You don't have rare earth metals. You are going to have massive disruptions in different areas because China has, we're codependent on each other to a large degree. China has reduced their exposure to us since 2018. 20% of their exports were to the U.S., and now it's down to 15% and dropping probably, but prior to this big tariff thing. So they've been working on this and preparing for this for quite some time. So that'll be interesting. Now there are some good things that happened this week that I think are really potentially really important. First of all, there's this concept. Comes from what they call Dow theory. So Charles Dow in the 1880s started writing, and it basically became the Wall Street Journal, right? And then after he passed away, successive editors for the Wall Street Journal started putting together all of his writings into what they now call the Dow theory. And part of that is what's called primary direction. So this has been going on for a really long time, and I'll just give you an example and show you why it's important today. So if you look at where those three red arrows are, that was the summer of 2023, actually July through October of 2023. And you can see we had some inflation kind of flaring back up, and the market was worried about it. And we saw, some highs, but they never got higher than the last high, right? So we kind of cascading down. And when the market's going down, you're looking at the highs, not the lows, okay? So then all of a sudden we ended up with a higher high. And lo and behold, we changed direction, right? I mean, that was not a primary move down. More things had to happen, but it's a good example. And so if you look at what's happened right now, okay, so here we have our, three arrows. All those highs are lower than each other. But then yesterday, we closed above the last high. And so far today, we're actually holding that. And so that's important too. You don't just fall right back down as far as that goes. So based on Dow theory and primary direction, there's several other pieces that go to this, but this is usually the first trigger comes in a situation where you get a higher high. And all of this has transpired since Tuesday, since we started saying, hey, we're not going to fire Chairman Powell. We are going to, reduce tariffs on China. We're in conversations with China, all of these nice things. Now, one thing that did come up today that was interesting, they said that pause that they did, the big pause, that was the huge update, it was a 90-day pause. And this includes basically every country in the world outside of China because they kept those tariffs. But they said today that they're not going to extend that pause. And they're trying to put pressure on these countries to come to the table and make these trade negotiations across the board. Trade negotiations actually, from what I've read, take a couple of years to really put into place and hammer out.
China and Mexico, the one that we had during the trade deal during the first term for Trump, took 2 years.
2 years, yeah. The USMCA, so that replaced NAFTA, Canada, Mexico, US, basically knocked the tariffs down to zero in most cases. And that did take a couple of years. But what they're doing is they're working on what's called a memorandum of understanding, which is just a much more streamlined, probably here's the number type of thing. And they'll have things that they want, so they're going to be busy as far as that goes. But that, to me, that's a good sign, right? That's a good piece, for the market itself. It's not enough for me to say, hey, we should be jumping back in, because this week when the market started to go up, we reduced our exposure. We were at 63% total stock market across the board with all of our clients. We dropped that down after Liberation Day to 23%. And again, the pieces that we have left are highly appreciated pieces or stocks that somebody wants us to keep, whatever that might be. Legacy, we call those legacy positions. And then based on the pause, we went back in another 10%. All right, so we were up to 33%. We've taken that back off the table this week because of the tariff inaction on China. Every day that goes by is another risk associated with what could happen. Because, again, if it takes us a couple of months to finally get that down, that could be very catastrophic. And the problem that we have here is that people aren't really accounting for the what could break, right? What could fail? In 2008 downturn, it was Lehman Brothers, and it cascaded us down. I hope we don't get there, but as long as that tariff is there, we're heading there. Mm-hmm. And so you have to think about that and say, okay, I need to be light on my foot and continue to focus on what's happening there. There is another thing I'll point out here that I think is really fascinating. So this is actually getting down into the 5-minute data on what's called a treasury yield. This is ticker symbol TNX. And so the whole thing, if you listen to Trump when he's talking, like he got really upset when Chairman Powell gave his presentation in Chicago and talked about how the Federal Reserve was very unlikely to do anything because they weren't sure, how much are the tariffs, how long are the tariffs, how much impact are the tariffs going to have on prices, right? Those are big ones. And so they felt like, okay, we're kind of stuck in the middle, right? We can't lower rates if the job market starts to fall apart like we normally would, because that might increase the pricing and we have even higher inflation. And so that's what really upset Trump as far as that goes and made him start to go after the Federal Reserve Chairman. And one of the things that they really seem to be trying to do is to drive down interest rates. We've heard that from Trump flat out multiple times. And there's a couple reasons for that. Probably the biggest one is that there's a big chunk of the U.S. debt coming due. It's currently $9.6 trillion, which is roughly a third of the U.S. debt, comes due this year, a lot of it by June. The average cost to the U.S. on that debt right now is 2.7%. And if you look what happened here, right after Liberation Day, yields were actually coming down, which is exactly what they wanted. There was concern about the economy, which is, I think, what they want here, to the point where yields are coming down through market forces. But then it got so far, and the rhetoric got so crazy, and that tariff board that he had, in the Rose Garden on Liberation Day, you're talking about a total calamity, and the feeling that the U.S. wasn't a place to have your money started to come in, and we saw a massive jump in the yields on the 10-year Treasury, all of them, but I'm using the 10-year here as an example. So that went from 3.9% up to 4.5%. Okay, over a couple of days.
That's massive.
It is massive, and it caused the pause, right? So there is a feedback loop that they're listening to, and it's right here. So if they get too crazy, and you can see actually that come back down to around 4.25%, not as low as it was prior to Liberation Day. And one of the issues is that if they're trying to bring down rates so that mortgage rates go down, Trump has loans he probably could refinance, so that they can refinance this debt for the Treasury. All of those things are good, and actually lower interest rates does stimulate the economy. There's no doubt about that. As a matter of fact, yesterday there was a lot of motion in the market to the positive side, just on the thought that there might be some more rate cuts coming. A couple of Fed governors said that they might be behind rate cuts, even with this tariff environment, if they saw a deterioration in the job market. And we're starting to see a little bit of that. So they're probably responding to that. So they're at least those two governors had you got to choose a side. Are we going to fight inflation, or are we going to help the job market, right? So they're choosing the side of helping the job market, which I think can be good. But this is what to watch. If you want to see what kind of pressure is being placed on the decisions for tariffs, it's the yield on this 10-year Treasury. And the weird thing is that the Federal Reserve sets short-term interest rates. They do not set the interest rates on 10-year Treasury. That's a market mechanism. So they indirectly set those rates when they cut short-term rates. It's basically the Fed funds rate is the amount of money, the cost to borrow for banks, for big institutions from the Fed. And ultimately, that generally has a motion towards the 10-year and the 20-year and 30-year and 5-year and all the other things that aren't short-term. But the market is a much bigger player in that. And if the market feels like the U.S. is unstable and not a place to be, and unfortunately, that's what we always have been. We rely upon being able to sell these Treasury bonds. It's a huge deal. I mean, we have a massive deficit every year. We fund that deficit by selling these Treasury bonds. If rates go up, it costs us more, to sell those. And they're trying to get through this big rate cut. Tax cut, right? And so when you're going to put through a tax cut, you can get, past Congress, but if you don't have 60 votes in the Senate, which they don't, then they have to do what's called reconciliation, right? And so reconciliation is a mechanism where, they take 10 years worth of data and they say, okay, your tax cuts are going to cost $4.5 trillion. Where are you going to get that money? And so what are you going to cut? They can't count tariffs as part of that increase on the other side. Because they're presidential tariffs. They can count those tariffs if they're passed by Congress, so that's possible. But actually, Congress right now has a bill, it's called the Tariff Review Act. It's in the Senate. There are 7 GOP senators who are behind this. They didn't write it. It was a Democrat who put it into play. But it's a pretty cool bill. It just says that if after 60 days, if Congress has not approved, right, the tariff, it disappears. That sounds awesome. And so it puts that tariff back into congressional control. So it looks like it could pass the Senate. I don't know if it could pass the House, but let's say it does. Unfortunately, Trump can veto it. So, and then you had to get 2/3 of the Senate and the House to override that veto. The only way that happens is if the market is down 40+% in my mind, and we're in total chaos, something is broken, and basically the Republican people that might have not voted for it are looking at it and say, well, yeah, they might primary me if I do vote for it, but it won't matter because I'm going to lose to the Democrat anyway because these tariffs have caused this significant pain. So impossible it could be resolved that way, but in my opinion, that's already too late as far as that goes. This is the biggest mechanism for resolving it, is what happens in the Treasury. Because the other area is the courts, right? And again, it's possible. Supreme Court, I don't think, is very happy about, being ignored on this, deportation of this gentleman from Maryland. And so maybe they would, go along with what the courts say and say basically that these tariffs are illegal because the president can only put tariffs in on an emergency situation. And so, but again, if we still have 145% tariff on China, we're not going to be able to wait for, the Supreme Court, the lower courts, and then the Supreme Court to finally get through these cases. There'll already be too much damage done. So I think this is the fastest mechanism for feedback. It has created a situation where they did the pause. That was big, right? If all those tariffs were still there, plus this China piece, it would really be crazy. So the pause is a big deal caused by this motion here. So that's kind of where we're at. It's an interesting time frame, and it'll be fascinating to see how this plays out. But this is unprecedented. This is the highest tariffs we've had in, almost 100 years. And the highest before that was another 100 years, 1828, 1930, and now 28 and 30 were both depressions, exaggerated by tariffs as far as that goes. The saying is that in order for, the reason they're 100 years apart is everybody has to die who was involved in the last one because,
They remember the pain.
yeah, they remember the pain that they caused. So that's why Wall Street is reacting so strongly one way or another to what is being said, right? So this week, things that were said from Tuesday on have been positive as far as that goes. Hey, we're going to reduce tariffs. We're in conversations. We're doing these things. The response to the CEOs coming to visit, those are all good things. And the market has established a higher high, which is, I think, really important. If you combine that with some really fast motion on the China tariffs and we get rid of all of these pause tariffs and the market's going to probably go really well, then we'll be able to see, maybe by September, October, okay, whatever tariffs are left, how much impact do they actually have? How's that affecting earnings? How's that affecting consumer behavior? I mean, we're already seeing consumer behavior being affected and CEO behavior being affected. Nobody wants to spend any money in this environment. Planes, hotels, cruises, all down, because you got people protesting the U.S. not traveling here, and you got U.S. citizens that are worried about their finances that are cutting back on their, on their expenses. This is the recipe for a recession. I don't think that they mind a recession. Matter of fact, one of the quotes that was attributed to Trump, and I've only seen it once, so it may not be true, but I wouldn't doubt it, which is just that he wouldn't particularly mind having a recession. I think especially if they means lower interest rates, which is what they're trying to do, but he doesn't want to cause a depression. The problem is you can't really control it. It's not that controllable. This isn't something, you can't negotiate your way out of 2008 type downturn once it really gets rolling, and especially when things start to break. You can't negotiate your way out of that.
Yeah, if a major company goes bankrupt because of the tariffs, you can't stop that.
No, and it could be a cascade of other things. And one thing we learned in 2008 is we don't know everything that's out there. Because what happened in 2008 was this credit default swaps, which were basically, insurance policies on top of these loans, these mortgages. So they're lending mortgages to anybody, and then they're insuring it, and everybody's defaulting on their mortgages, and these companies had to pay off. Lehman being one of those big ones, actually. And once Lehman failed and all those credit default swaps had to be paid off, everybody sold everything, which somebody was asking me the other day about gold. Why don't you have gold in the portfolio? It's doing so well. And it's right. It's the one key diversifier tool that has worked quite well here. But the problem for gold, in my experience, okay, is that it is a storage of value. People put it there to hold their value. If they're worried about currencies or whatever it is, gold's that storage of value. But in 2008, everybody needed money. And so they sold everything, every good stock, gold included. There was no diversification strategy. That's why we use T-bills instead of gold as our hedge, because T-bills still paid. They continue to pay pretty much every day. They're up slightly. And so that's there's not a lot of places to hide if we're going to head into something along those lines. And this tariff thing could create a 2008 type of downturn, a real one where you have, economic problems that can't be solved. The one thing we did learn in 2008, and I think this is important, is that we could stimulus our way out of that bottom. That could have turned into a depression. We were down 57%. They started all kinds of TARF and TARP and sending money out to individuals in the U.S. here. And the quantitative easing, the Fed starts to buy treasury bonds, on the open market, started at that point in time. So there are some tools, but they're also inflationary. So it's not really possible in the real world to have inflation during a recession unless you have tariffs. It's the only way I can think of where you could have both. And that's what they call stagflation. Technically, stagflation is slow growth, not falling growth. So we'll see what happens. So there's enough question marks here to look at this and say, okay, this might be it. This might be the recovery. It's going to come back. Federal Reserve might start lowering rates. might be able to get China, on board pretty quickly, and we're done. Just like in 2018, we dropped almost exactly the same amount, just short of 20% in both cases, and now we're going to come back and we're going to move on to other subjects or whatever it might be. So, that's definitely possible. There could be some great buying opportunities in here, but in my opinion, until that 145% tariff on China is dealt with, it's time to be cautious and just wait it out as far as that goes. So anyway, very interesting time to be an investor. You're going to learn a lot about how all these things work. I'm happy to discuss this, and we'll look forward to talking about it again next week. All right, so let's start with our first question.
So what do you need to see to re-enter the market, even if it's just partially re-enter the market? What do you want to see?
Well, one of the first things I want to see is a higher high, right? Which we just did yesterday.
Mm-hmm.
So that's a really big deal to me. I'm a little worried about it because everything is sort of manufactured here. I mean, this is not a crisis that it was created by economic numbers or, like that. When I talked about the 10% drop and how that worked in the summer and early fall of 2023, that was because of numbers that were coming through that were showing the potential for higher inflation, and the market was worried about that. This is just a couple people deciding that they want to put these massive tariffs on every country in the world. And then, of course, the market drops. We lose $11 trillion of market value since Inauguration Day when we got down to that low point. And then they can change their tone. Hey, let's pause this. Let's start, Monday we're down 2.5% because we're going to fire Powell. Tuesday through Friday, we're back up hitting, we beat the high that was established in that pause because we're, talking better. So you can go either way. And then today they come out and say, well, we're threatening, to not extend this pause on all of these other countries. And so it's just super messy. And it's hard to say whether or not, the whole Dow theory of higher highs holds up here or not in the middle of this. I don't think it would, actually. As a matter of fact, I can guarantee you if they keep 145% tariff on there till pick a time, summer, that higher high won't matter. So that's the key piece for my reentry is motion, strong motion towards reducing the tariff on China. And I think everybody on the planet is thinking the same thing. So there's hope that that's going to happen. I hope by next week there's something that happens that's substantial. Let's lower our tariff from 145 to 125 to match what they've done. I think that would be a good move. It shows them something. Maybe we can start some real conversations. And Trump wants to talk directly with Xi Jinping. That might be a way to get it to happen, to do something. So I would look forward to that. Maybe there's some partial movement just based on that. We'll see what's happening otherwise, but it's a really, really hard market to deal with. Very, very difficult because it's not normal. It's one person essentially making up their mind one way or another, and so you can get out and they can change their mind like it did on Tuesday. We got out on Tuesday partially, and they changed their mind. Said, "Hey, we're not going to fire Powell." So this is an impossible environment to try to manage assets, which I'm pretty happy to be sitting on the sidelines for most of this because even if I miss out on some upturn, I'm okay. I'd rather preserve the capital we have because you never know. If something break tomorrow and we'd have some more problems as far as that goes. You might get to a point here where you can't talk your way out of the downturn. Mm-hmm. or the upturn in yields on the bond market or the collapsing of the bond market. I mean, Liz Truss got booted out as the Prime Minister of England because she came up with a plan that the bond market hated, and so for the most part, the bond market doesn't like this plan. You can see it, big giant jump. So we'll see how that plays out. All right. What other questions do we have?
So, what is a charitable gift annuity?
Charitable gift annuity. All right, so this is, you have a highly appreciated asset, let's say. You worked at a company and you got a bunch of their stock.
Yeah.
And so, capital gains are hard to pay. So you would, and you like a charity, you like giving money to charities, all these things have to kind of be there. But you give money to a charity and it goes into an annuity with that charity. And it's based on your age, right? It
Yeah.
will pay you for life. Go
So
ahead.
so it's kind of like just a contract. You enter a contract with this charity. They'll give you a lifetime income. Usually, most charities say you have to be 60 or older to enter these contracts, and they'll pay for the rest of your life. And then there'll be a remainder interest that then goes to the charity. And so that remainder interest they allow you to deduct from as a tax. A charitable donation. Um, and so a lot of people do this is because you want to diversify, and you have a highly appreciated asset. Now you can diversify into a steady income stream. The income stream is taxable, but it's guaranteed, so it kind of protects you in that way.
Yeah, the charities are doing what the insurance companies do. They take your money, they look at the actuarial tables, and they say, okay, we can pay you this much per year for the rest of your life and still have something left over at the end. Now, you might exceed those actuarial tables, and in those cases, sometimes the insurance company can actually lose money. I'm sure that's true here with these charities. But overall, when you get a pool of enough people doing it, the actuarial tables become pretty accurate.
Yeah.
And so, if I give $1 million and get back 750,000 in payments for life, then the charity gets 250. We're making up these numbers, but if I happen to live way longer and the charity gives me $1.25 million, then I, maybe
And the nice thing
made
is,
more.
if you don't actually live that long, you can actually, your estate can actually say, hey, we didn't hit the life expectancy. We are entitled to an extra tax deduction, and they can actually recover some of that.
Yeah, because that's what we didn't cover that. I mean, when you put that $1 million to that charity from your highly appreciated stock, you actually get a write-off. And so what Easton's saying is there's an additional potential for write-off if you didn't live that long, as far as that goes too. So that's the other advantage of this. You're helping a charity, you're diversifying out of an asset, you are establishing a steady stream of income without having to pay the capital gains. It is taxable, but nonetheless, and you no longer have that $1 million to worry about. It turning into $500,000 or something because of the market downturn. And so it's a really interesting area. I think you'd want to really look carefully at who's making those guarantees and how those guarantees are established. Is it just the insurance? Is there an insurance company behind the scenes that's kind of standing behind that, or is it just the charity itself?
Yeah, and how big is the charity?
Right.
Because if you have a massive charity, you can also do colleges, is very common too.
Yes.
And so there's a lot of different, I think it's 501 C organizations. And so you have a lot of options. So you want to pick the right one that matches your interests.
Yeah, because I mean, are you the only one at this small charity? And they run out of money, because you live longer or whatever. How many other people? Because to really make a charitable annuity work, like the insurance companies, it's a numbers game. You need a lot of people in that pool so that the actuarial tables actually come out to be accurate over. You have 3 people that are doing it at some small thing. They could all live longer than expected. The charity could blow up that annuity. So you definitely want to look at some of those pieces. Like you say, the big universities are probably a good place. There's probably a lot of money, a lot of people. You want to make sure that the charity or what have you that you're going into there is, sustainable for your income, because they're the ones making the guarantee. There may be some insurance companies behind the scenes in some of these too, but if they're going to take the risk, they're probably going to take most of the money, which makes you think really it's probably just the charity standing behind it. Yeah, it's a good question.
So how do you pick which highly appreciated stock to sell? After this run, I have some equity. I'm a little bit overweight in equity. I want to kind of sell some of my highly appreciated stock, but how do I pick which one?
So this is pretty interesting. There's a pretty simple little calculation that you can do. Let's say you have a list of stocks or ETFs or whatever, and they're some of them or all of them are highly appreciated. You can do a little calculation to try to figure out, what percentage you're going to lose. So, for example, if I have $1 million position and it has grown to 1.1 million. I have a
Mm-hmm.
$100,000 gain, right? Let's just say for the sake of argument, my taxes, state and federal, are 30%. So you'd want to figure that out. What would be the tax for capital gains, long term? I'm assuming in this case, at capital gains. So if I'm going to pay 30,000 at a 1.1 million, right? It's a little less than 3%.
Yeah.
So I look at that as a percentage basis. So 3% is something I can get back, most likely, right?
Yeah. Can I get that back in the market if I move to a different investment or
Yeah, in
vehicle?
theory, I just need the market to drop 3% and get back in, and I've broken even, and now I got my cost basis paid for on that piece. Let's say you do the same thing, but instead of $1 million, it's $100,000, right? And now I made I double my money. It's worth $200,000. Okay, the tax is still going to be $30,000. Same tax if at 30%. Again, got to figure out your own. But now I'm looking at a 15% cost to sell that. I need a fairly significant, and if I'm selling this just to avoid, losing money in the market, I need a fairly significant downturn to justify that. And so that's why it's so difficult when we look at these appreciated assets, is why we haven't done it yet. Because we did a little, but nothing substantial. And the reason is because, there is a cost to moving out for that tax. Now, there's not a lot of ways out of that tax. You might pay it anyway at some point in time
The
because
only
you
way
need the
is
money.
death, basically.
Yeah, you got to die, or somebody, if you're married, your spouse has to die to get the step up, which is, the biggest penalty that I can imagine. So sometimes, we get a little bit lost in that, but I'm going to choose off of this list what to sell first in order to reduce my overall, exposure to the market. I'm going to line them up by percent, right? So, hey, that piece only has a 3% cost to get rid of versus the value, and I'm going to sell those lowest percent ones first, with the exception being, I love this holding. I think this holding is going to do great. So there does have to be some aspect of how you feel about the future of that particular holding. And theoretically, you might be buying it back anyway, if the market does go lower, if you really love it that much. But, that's how you do it. You would line it up by percent and start to take a look at, what am I dealing with here in terms of, so it has to do with the value of the gain versus the value of the cost basis, your original investment, and then figure out your tax and how much. So 3%, a lot better than 15. Might sell the 3% piece, and especially since I'm getting rid of $1.1 million of exposure to the stock market for 3% versus just $200,000 exposure for 15%. So that's the calculation. That's how you do it. That's how we look at it as far as that goes. I hope we don't get there. I don't want to take these gains. The clients always get upset when we take gains. Unless everything falls apart, people will be really happy with it. But you have no idea what's really going to happen, especially in this environment.
Yeah, there's no way to guarantee a future guaranteed outcome, so you just don't know.
Yeah, but we can guarantee you're going to have to pay the tax if we sell
Yeah.
it. So that's the problem. There's a guarantee on one side that's negative, and there's not a guarantee on the other side for what might be positive, which ironically is actually the market falling farther, so that you save some of that. I've seen situations where we took some really big gains, and in that particular stock dropped so much that actually wiped out all of the gains that they would have had, and so it was a good idea to take it. You celebrate that, even though you paid a lot of tax, but you kind of need that, to make the story balance out. So, all right, that's our show for today. Again, really interesting time frame to be looking at things. I look forward to being able to see you again next week. And of course, we do the videos daily if you want to see what's going on. Monday through Thursday. Try to keep those going as much as possible. And again, if you want to send in some questions for us to cover next week, you can send that to ask Tom at talkmoneywithtom.com, and or you can subscribe to the channel, which I think would be a good idea. Just continue your education in these areas. And then lastly, of course, if you just want to meet with Ethan and I, you can do that by going to the book appointment button. So look forward to being able to see everybody next week, and thank you for joining us today.